Hey, Dan Passarelli here. Today, we had kind of a boring day in the market. The market was pretty much unchanged. I think people are trying to figure out what the shutdown means. So I thought I would take today to show you something that is actually really important. When you use volatility, we do a couple of things. The first thing we do, of course, is we start by looking at the volatility chart, compare implied to historical, compare today's implied to implied in the past. But then we need to go and look at the exact implied volatility of the exact option we're looking to trade, because that's the volatility level we're actually buying or selling. That's the one that matters. So we look at the options chain. But here's a problem. You can set up your volatility column in your options chain a couple of different ways, and there's really only one right way to do it. In order to do this, we have to go and look at how it's set up. So we go to the top right-hand corner of Thinkorswim, click on Setup, click on Application Settings, and then we go to Calculations. Volatility calculation mode is right here, and there are three choices: volatility smile approximation, individual implied volatility, and fixed volatility per expiration date. Now we're just working backwards. Fixed volatility per expiration date means the volatility for every strike would be the same, which is just not how reality is when it comes to options. Individual implied volatility means, well, if this one's market is this, the theoretical value is calculated in the middle, then the implied volatility would be this. But if this one happens to have a bid that's mid-market, that'll make the implied volatility on that one look higher, and the implied volatilities won't really make sense either. So we need to use volatility smile approximation, and we click Applied Settings. When we do, as we look at this, we see that going from the middle, the at the money, as the strikes get lower, the implied volatility gets higher. It gets about 0.38 higher, 0.45 higher, 0.9 higher, and it increases at an increasing rate until it levels off. As the strikes get higher, volatility gets lower, and this is very, very natural. But usually on the higher side, implied volatility gets lower slower. This is just like 0.15, this is 0.25, 0.2, 0.13, 0.06, and not even a change at all. So that is what we call, technically, we actually call it a volatility sneer. If we go to charts and then product depth, this is what I'm talking about. This is the, oops, actually I got the wrong one here. Let's skip that back on Citigroup. These are the graphs of what we were just looking at, the vertical skew, the volatility per strike within each expiration, all mapped out. Now here we've got all 20 series. We don't have to look at all those. We'll get rid of the shortest term ones. We'll get rid of the longest term ones for sure. Just look at the more liquidly traded ones. Get into this year anyway. And this is a pretty good idea what we're talking about. Here we have the at the money at 97.34 right there. And we see that the lower strikes, the implied volatilities go up, up, up. That's this axis at an increasing rate. And as the stock price goes higher, implied volatilities go lower, but they sort of start leveling off. And in fact, at some point, especially in the shorter expirations, they actually start ticking back up higher. This is pretty important stuff. I hope that this all resonated and made a lot of sense for you. This is going to help you to be a better trader. This is Dan Passarelli. Trade smart.